We put a deal under contract every day last week. We put 8 or 9 under contract. We listed another 7 or 8. A huge delta than any month that we had in 2025.
Started at Unique, then you started your own shop with Adam, Nexus, got absorbed by Capstone, and then now you're wearing the MMG banner.
Yeah, it's been a trip.
Yeah.
It's been an absolute trip.
Now we're starting to see the bottoming of Denver a bit. Out of all our markets, Denver is the toughest right now.
For sure.
It's everyone's like, oh, GFC was harder than this. Maybe in some benchmarks, yes. But as a broker, it was like a slope leap.
It's like a dimmer switch instead of a light switch.
Exactly.
There's no lack of capital out there. It's just lack of capital necessarily ready to write the check for your deal.
The management upside play is very real. Denver is transitioning because it is in a flux. Now it's based on who's the operator and who's the manager. You're starting to see the good ones from the bad ones.
We're at 80 cents instead of cash flowing capital calls. You're not cash flowing. You don't got money for CapEx. Your cash out refis, now cash in refi. You got a lot more problems and waiting. And that's what we're seeing come to fruition now.
All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Jason Koch.
Thanks for having me.
Great to have you.
Absolutely.
Here in sunny LA.
It's beautiful out here.
Fresh off a flight right now.
Got more early morning flight, 24-hour trip.
You got the energy drink.
I needed a little bit. It was an early morning.
You already. Every time I see you, you already have enough energy. I don't even know why you need an energy drink.
You got to keep it going, man.
Yeah.
The market's busy.
I know.
You got to get it.
It's busy, but is it transacting? I don't know. We'll see.
We'll find out.
It's
I
kind
feel
of a
like
grind.
You got to start on the front end of it, right, before you see the closings.
Yeah.
And you could tell it changed in February.
Yeah.
Big time. Everyone started talking about it in January, but February, we put a deal under contract every day last week, for example. I think we put 8 or 9 under contract as a whole in February, and I think we listed another 7 or 8 as well, which was a huge delta than any month that we had in 2025.
Because usually you hear we have a lot of BOV activity, but it's not translating.
Yeah.
So
and then things actually go under contract. It's that's fantastic.
It's different this year. It definitely feels different.
It feels different.
And you're making the rounds in LA,
absolutely.
you're here for that.
Yes,
I think that's
shake hands, see you.
That makes a difference too.
Welcome back to LA, by the way.
Thank you. I mean, listen, it was the big move. I gotta be careful what I say, right? Because of tax status, But,
oh God!
Sorry.
Welcome back to visiting LA.
No. Thank you. It's a big visit. No, I actually haven't moved. Really I still have some term in my lease in Miami.
You're renting a studio perpetually for the next 5 years.
I haven't signed the lease yet in LA. So on paper.
That's really funny.
Yeah. It's you have to know when are you able. As soon as I sign my lease, I'm going to switch. I'm going to switch status.
That checks out. That's smart, though.
I think that's fair.
I might overtake your lease in Miami if that's cool.
Yeah, I mean, I already have some friends that are subleasing right now, and they're like, "Can I
just put me on the lease?" And that's fine.
Yeah, exactly.
I'll sublease to them.
Just run back and forth.
I could use it.
Jason, back to business. So great having you. Quick intro. Jason is managing director of MMG. This is actually full circle for you, right? Because you started at Unique, and then you started your own shop with Adam, Nexus, and then you really grew that platform out. Credit to you guys.
Thank you.
And then got absorbed by Capstone, and then now you're wearing the MMG banner.
Yeah.
And so back to having the brand, and would love to also dive in maybe later on of just how it's been going from, you've ran the gamut now at this point.
Yeah, it's been a trip.
Yeah.
It's been an absolute trip. I mean, I was with Unique for 10 years, right? So I was just at one shop for a long time. And it was great. It was nothing to complain about there. It was a great run. The market was fantastic. I learned a ton from everybody there.
And they're still going.
And they're still going. And they're still doing their thing, right? And so that was fantastic. But we had a big team there. We had a lot of success. And the market was on fire. So we're also in the right place, right time, in fairness. We had a great team, got exposure to a ton of deals, right? We were closing, at our height, on our team, we were doing 100 deals a year in closings, let alone underwritings and deals we didn't get closed.
And it was
offers.
all boutique, smaller market type of stuff too, right? Or did you have some bigger?
No, at the time, at the time it was anything from $1 million to 10 million type deals, right?
And you just did all. You were just
which granted, those are $2 to $20 million deals today. In fairness,
but so true.
But the values, it was generally around that range. We were just cranking them, and it was a blast. It was fun. The market was on fire. Denver was changing a lot. So
it was exciting.
To be a part of that, like we really went through different iterations of like who owns multifamily in Denver. As coming out of the GFC, it was all local players who just knew price per pound. This is a good spot or good location or whatever, right? And then in 2015, 14, whatever, we got more on the map from a population, et cetera. And so
it got institutionalized.
Yeah, it got institutionalized. New York started calling, Chicago, Boston, bigger players from California, that sort of stuff, right?
Yeah.
And so that changed. And then I think it was 17, 18 is when we pivoted to Nexus, and just Humpty Dumpty fell apart. We had a big team, a lot of moving parts, fell apart. And so me and Adam decided to kind of give it a go on our own, right? And see if we could build a better mousetrap. And that was a blast. That was an absolute blast. It was exciting. The market was still helping, in fairness, right? And
good time.
Yeah, so it was good time. You look back, it was like, that was fun.
Yeah.
And so we had a blast doing that. We grew it. We got like to 10, 12 people, got back to a very similar transaction volume and all that fun stuff.
Started doing more middle market stuff too. You guys had some good.
Yeah, we grew into that. Yeah. Absolutely. Good memory. And so that was good. Learned what it is to manage more employees and processes and back of the house, which had the fun part of that was it was a different job. Like I've really been doing the same job for 10 years, right? Just kind of straight up brokerage, where now you learn how to manage people and processes and all the other things that just kind of go into it. And so I enjoyed that from like the challenge aspect.
Right.
But it was more on your shoulders and more like you're still trying to broker, but then you're trying to manage people, manage a process, manage expenses, and just all the other things
you love brokering, and now you have to run a company.
Now you got to run a company,
and you have to deal with HR. Yeah,
someone's like, we want more LoopNet lead, more spots on LoopNet. You're like, well, that's another $500. Let's talk about it. Like it's just such a different perspective of it.
Right.
But it was very successful, and we had a lot of fun with it. And then we really always wanted to have more of a regional presence, right? We'd add more value to our clients by having a bigger banner, more connections, especially out west, right? And so we tried growing that, and turns out that's really hard to do. We always say we pursued this one broker in Oklahoma, and he was the closest to doing it. But he was really leaning on us like, hey, what does the Nexus brand bring to me in Oklahoma? And our answer wasn't very good because it didn't bring a lot of value to him, is the reality.
It was like a local.
Yeah, it was like end of the day, not much. So it was a rough pitch, to be honest. And so we had built a relationship with Capstone prior. We just got to know him by NMHC, running into him. I think we actually tried to recruit like one of the owner's brothers, not knowing. And so that didn't go well. And, but we ended up building this like, hey, we don't really compete. And so let's just share ideas and get to know each other. And that turned into, hey, why don't you guys help us grow west? Because we're really the East Coast, headquartered in Charlotte, stuff like that. And so why don't we just kind of join forces here, and you guys can help us grow west? And so that worked out. And that was very successful. Like that was totally valued. No regrets in doing that. Got exposed to a lot of great brokers, great ideas. And that was probably the biggest benefit for me and Adam directly, is we had started a local shop. We were both trained by very similar people. And so we very much were on the same page of what the mousetrap is and how it works. And turns out there's a lot of ways to do this business, and a lot of just different exposure to guys and how they approach it and how they do a presentation or underwriting, all that stuff. And so that was the biggest value for us. It's been like, wow, like we do it this way. Look how that guy does it. Like that's really good, or that's really good. Just like you're really good at like meeting with other principals, right? And like, how do you guys approach the business? How do you underwrite deals? How do you finance it? Well, all the things, right? And so that was of huge benefit to us. The market was good too. And so we got to do even larger deals and get exposed to new principals and all that fun stuff. And so that was a blast in its own right, but very new, right? Got to learn a lot during that time. And that was fantastic. And then when the market turned, when the rates went up and volume went down, right?
Party's over.
Party's over, right? You kind of, the water goes out, you find out who's not wearing pants. And Capstone was wonderful, but they didn't reinvest into their systems and processes as much as they should have. And if they were sitting next to me, they'd say the same thing. And so systemically, there was a struggle if you viewed them long term, and that became a problem for the brokerages at the shop. And so we pivoted there. We got connected with MMG, and they were all the processes we were looking for, right? They were the foundation. They were the collaboration where it still has the heartbeat, the soul of a boutique shop, but much more the resources and the branding of a much larger flag.
Yeah.
And so that's been a fantastic pivot. Now, conversely, the other three, the market was really good when we became those other ones, right? So we're able to just come out of the gates running. Here, the transition was much more in a much down market. And so it's becoming a lot more exciting now just because the market's starting to cooperate.
And you're planting the seeds now, and like you're going to start to see the fruits of the benefit reap
for
from
sure.
that.
Yeah, for sure. And the connections are way better. And then everything, I think everyone's just excited for the market to get going again.
Yeah.
Right. And so you can just tell the energy and everything's back. Now, granted, we have a lot of Midwest offices. They've been back for 6 to 9 months from a volume standpoint. We're on these calls and they're like, we had 30 offers and 50 tours and 200 CAs. And we're like, we're not getting that in Denver yet. So we're excited from a local standpoint to be kind of transitioning into that.
So tell me about that. Like now we're starting to see, the bottoming of Denver a bit and starting to see it maybe back a little bit, like glimpses of hope. Like, what are you seeing? Looks like deal volume wise, you might be starting to see a little bit more activity. Operationally wise, I don't know if you're seeing as much of a glimmer, but I think maybe from some of these deals trading hands, someone has a better way of like recapitalizing the deal and getting it to where it needs to be. Like, where do you see Denver kind of heading?
Well, let's flip it on you. Like, how are your guys' operations for a little bit?
Yeah, I think
even too much, but
no. I mean, out of all our markets, Denver is the toughest right now
for sure. Right?
It's so we're just pretty jaded in that way, and we just feel like pricing hasn't really reset yet enough. And I think like you and I, when we saw each other in Salt Lake City a couple weeks ago, you were like, you think GFC? Like everyone's like, oh, GFC was harder than this, and like maybe in some benchmarks, yes, but as a broker, it was like a slow bleed. This it's
like a dimmer switch instead of a light switch.
Exactly. And so that really resonated because I feel like it's hard to reset basis and like it's a Band-Aid. Like you just got to rip it off, right? And the GFC, like the lenders got the deals and they're like, all right, sell it. And they would sell it. And then we can like reset the basis and get back to doing, value add and business plans. Here, it was very much like so many false starts.
For sure.
And I feel like Denver is even like got to experience the worst side of that. Why? Because from a supply standpoint, operationally made it really tough. And then there's, some other reasons why it could have been tougher too on top of supply, but supply was the main reason. And then capital markets. So the two forces really hit Denver more than any other market I've seen.
Yeah, I would totally agree with that. Yeah. And on the GFC, like it was a hard reset, right? And if you're a part of the reckoning, that obviously was terrible for you and you're out of the business or whatever, you had a total reset. But if you weren't part of it, you were salivating to get into it on the reset, right? Yeah. And on the sell side, the banks, whoever took over the properties, they were sellers at market clearing prices, right? That was part of just how the government dealt with the banks and all the different reasons, but they were relatively ready to sell. And that was a huge difference. Where in this market, we don't have that. Like even if a deal goes back to a bank, like it's going to the bridge lender, it's going to the prep, it's going to the LPs, like all these different layers. And most of them are saying, if I can't get my dollar, I'm just going to hold it.
Yeah.
And holding it wasn't an option during the GFC. Or here they're like, I believe in the asset. I got a good asset, whether it's in Denver or Salt Lake, all these different markets. And so I'm just going to wait. And I'll wait a year, I'll wait 2 years, I'll wait 3 years. Or I'll work with my sponsors. My sponsors have put together sponsor. It's a good operator, whatever. And the working with the sponsor is more common on a bigger bank standpoint where like the bigger bank doesn't want the property. They don't want to operate it, but yet they don't want to take a hit to their dollar. And so like, instead of taking a hit, we're just going to work with the sponsor and maybe we lose on the margins, but we don't take 70 cents on the dollar and have to write off this loss. So maybe we lose, on the margins in the meantime, but we'll wait 1, 2, 3 years. And instead of getting 70 cents, ideally we get our full dollar back or we can get 95 cents, whatever it is. But economically, it makes more sense to simply work with the sponsors. The sponsors have put together sponsor, they're good at managing it, all that fun stuff. Much more so than if we took it back. Like if we take it back, we're gonna be a crappy manager. And so why not just have this person manage it? And the benefit
and there's optimism, right?
Yeah, right.
That's the optimism's kind of like getting the lender.
And everyone kind of believes in the story.
Yeah.
Like at GFC, it was also a little bit like the world's crumbling. I don't know what it's going to look like in 2 years. Here, there's a lot of optimism and like, hey, just given the supply wave going away, this has to get better, right? Yeah. The majority of people believe in that story.
Yeah.
So they're able to forecast the future with much more confidence than you did in 08. In 08, you're like, I don't know what's going to happen.
No, I mean, I definitely believe in Denver long term, right?
Yeah.
Like I do feel like it really, yes, there was a few things with Denver that were specific that may have deterred operations more than supply. Some of the migration patterns, like with ICE, I feel like there was a little bit of that in like specific pockets of Denver, but it wasn't Denver as a whole. And I feel like once that supply is absorbed, you're still having a lot of inbound migration. You're still having a lot of people. There's an appeal to Denver wanting to live there with the mountains. And if they can just get their, I guess, like, you know, giving the right tools for landlords to succeed and not making it so cumbersome to operate, I think Denver will be in a much better place.
You think that's going to change? Because we've been making it harder on landlords for a little bit.
Yeah, we broke into Denver because we liked how it was the best of both worlds of being a purple state, right? You had fiscally conservative, socially liberal. That was like the Denver, like, value add story.
For sure.
And it had that cachet. Now it's almost the worst of both, right? At least in some of the blue states, they're a little more supply constrained.
Yeah, for sure.
Or in the red states, they're a little bit more landlord friendly. Here it's like supply and tough landlord, you know, political obligations there. So
yeah, we've certainly seen groups that, it's been interesting because there's groups that are new to the market that are saying, hey, from what I'm leaving, this is still way better than what I'm trading out of, right? From an operations standpoint. But then other groups are saying, hey, I bought into this market with operations being this hard. Now they're this hard. I'm no longer a player in the Denver market, right? I'm now pursuing Kansas City or other markets where that are more landlord friendly. So we've certainly seen capital that Denver was on their list saying we're no longer part of their list, or at least for the time being. Right, until certain things get worked out.
And we're actually kind of zagging when everyone's zigging in that regard with our management, because we're finding that out of necessity, we got to manage our way out of some of these operationally troubled assets. And we're looking on paper and we're like, wow, we're actually outperforming our rent comps. And so our strategy now is, hey, while pricing is still working to get reset, like my take is that Denver pricing still needs to reset. It's just not there just yet. I think this is the year it could happen. But point being, we can manage for some of these operators that are struggling, that are like, hey, I'm done with the operations here. And we'll come and we'll help them. And maybe there's a play there to...
Yeah, because you guys are getting more into the third party at this point, right?
Exactly. Yeah. So we're going from self-managing to now third party for others, and Denver being like a perfect market for that.
In fairness, management for Denver is absolutely in flux, just because it's got changed so much in terms of just
HB 1090,
what being a manager is.
Yeah.
We had one management company come to our office. This was probably even a year or 2 years ago. And he brought in this booklet, and it was like 10 pages, right? And he's like, hey, these are like the laws we got to know as managers, just be aware of with our tenants. And then he put out this giant book, like a thesaurus, right? He's like, this is what we have to be aware of today. Like, we have to be like halfway a lawyer just to understand all this stuff. Yeah. And so in fairness to managers, because management's really struggled in the Denver metro and like who's the right group to go to and who's doing a good job. And it helps when you're bigger versus smaller and all that fun stuff. But it's
some of the big ones like
it's
are
in
too
transition.
Big.
Yeah, it's certainly in transition of kind of who's the players in town.
Yeah.
And in fairness to them though, managing is a totally different game than it was 5 years ago in the Denver market.
You're not getting saved by rent growth anymore.
But it's absolutely the new value add. It's the new priority. It's the new model. I mean, you're not painting units and doing lipstick on it and raising rents. Like you're just managerially on top of it. How quickly do you turn it? How do you market it? How do you fill it? You feel with good people? Like all that fun stuff is really the new value add to a property today.
Yeah, the management upside play is very real now. And I do feel like Denver is transitioning because it is in a flux because of some of these regulations. So it was a lot based on market, and now it's based on who's the operator and who's the manager, and you're starting to see the good ones from the bad ones. Yeah,
we got one deal. I was talking to an owner, and he was saying they were, whatever, they're 93, 95% occupied. The asset next to them, which in fairness is a better asset, not drastically, but it's a better asset, and they're 40% full.
Yeah.
And lower, and their rents are lower, and they're still 40%.
That's
full.
Not market.
It's a total. I was like, that's not the market issue. That's a management issue, and it's just drastically different.
Yeah, exactly. So your team has, maybe out of necessity, like diversified listings outside of Denver at this point. Like I see Adam and others in Austin, other people's on your team, they're looking at Wyoming. They have deals in Salt Lake City, and like, is that like, how did you guys get to diversifying into these other markets and like building the team geographically?
Right, great question. So to a degree, yes. I mean, much more so the last 1 or 2 years in terms of just because volumes just tanked, especially in the Denver metro and Colorado Springs. I've done a lot in Colorado Springs, and volume down there is just totally tanked. And so you had to chase yield. So that was the Wyoming market. But we've also been doing a lot of land. And so that brought us into Montana, in fairness. And so we've gotten to build a lot of really great relationships in Montana. And that, like, if you can get something in Montana, especially the go-to cities, there's a huge market for that on the back end. That deal's going to trade to somebody, right? If you got a deal there. And then we have a local office in Salt Lake. And so that is really worked by Will and Alex in Salt Lake. And I oversee that, and I'm a part of that. And we chased Salt Lake as we viewed Salt Lake as kind of a similar story to Colorado Springs, right? You got to have the local presence, but there's a real story that Salt Lake's really bifurcated in that you have the big shops that have been there a long time, and then you have a lot of local brokers that are even doing like 20, 30, 40 units, which in Salt Lake, especially in the good times, 1970s 30 unit was like 300 a door.
Right.
And so it's like, there's a lot of opportunity here to come in and be that shop and take some of that market share. And so it diversified our efforts. With the MMG platform, it really helps because we're connecting more dots on owners where you talk to an owner, it's like, hey, I own in Denver, but I also own in Salt Lake, or I also own in Montana. It's like,
is there a lot of
we can do something about
there?
that.
Yeah. I feel like there's a lot of synergies. Like if someone's putting on their list, like I want to chase Salt Lake City, they probably have Denver on there
for sure,
or vice versa.
Absolutely. Just Denver and Salt Lake talk to each other for sure.
Yeah.
You know, the Montana, the Boise even is a little different because it's smaller, right? So you got to get the group that's okay with a little smaller population investment, which only certain groups are, certain groups aren't. But Salt Lake talks to Denver right away.
Yeah.
Right. In terms of the style of the investment, the people they're going after, the mindset. Salt Lake's a lot what people were investing in Denver in 2017 mentality. The hurdle with Salt Lake is most people know that. And so the cap rates on Salt Lake are lower than Denver.
Right.
And so you gotta kind of pay to play. Everyone loves the market, but the con is everyone loves the market. And so there's a lot of competition in Salt Lake. If you get an asset that people want, there's a lot of demand for it.
You look at a report for Salt Lake City and you see it's really popping off the page, inbound migration, jobs, people moving there, birth rate increase. Yeah. Having a lot of babies.
A lot of babies. And they don't leave. You know, they stay. And I don't think they should. It's a beautiful city.
But then you go deeper and you're like, okay, now I want to buy a deal, and you start underwriting it and you're like, what cap rate? Like a sub 5 for this 80s vintage deal, like in a workforce market. So that was this. There's definitely a scarcity premium. That's one. It feels like the volume of deals is just not as there. So when there is a deal and there is a listing, everyone wants to get in, and they're looking at it beyond the numbers on the page. They're looking at it for what it could become. For sure. I mean, we just took out, or we've ran the process for the last 30 days, and it's a 140-ish unit converted motel, 1970s build. I mean, it doesn't check a lot of boxes physically, but it's big enough that, someone can have on site in certain boxes. I mean, we had 120 CAs. We probably had 50 interested parties that asked for numbers, had another 10, 20 people look at it. Like, the activity on it was fantastic for an asset that physically doesn't pop out, right? And people still looked at it. So then you go get a newer build or a town or something like that. It's competitive for sure. Yeah. People want to be there. So going back to Denver a bit, you guys have a few listings out, and you could talk your book, you could not talk your book, whatever. But what do you think is like the best submarket to kind of like invest in right now in Denver? Oh gosh, great question. And it's funny, we get asked that a decent amount of like, where's the opportunity? And my answer to that a lot of times is I've seen people crush it in the worst parts of Denver. And I've seen people miss when buying in Cherry Creek. Yeah. Right. And I know people love to say location. Demos alone, that's not true. Like demos alone is not going to save your deal. It's not. No, maybe if you have a 20-year plan, then I'd rather buy in Cherry Creek than North Aurora. Right. Yeah. Like, at some point location does help, obviously. But especially today, it's the value add is buying the right price per pound relative to the market. Right. Are you buying 90 a door in North Aurora? Are you buying 130 a door in North Aurora? Similar to Cap Hill. I mean, right now it's a price per pound play. That's the new value add. Are you buying the deal that you're able to get at the right price? Do you believe? And that's not. And sorry to catch up. Yeah. That's not
area agnostic right now, right?
Yeah.
I mean, certain areas are hurt more, and so you get a little bit more of that motivation, but everyone's feeling the pain, just a little bit in their own way, right? Whether it's some of the workforce housing stuff, they got their own problems, but the new builds, they're giving away concessions. And so a lot of the problems are much more related to how that capital stack got structured than what happened to be in Wheat Ridge versus Lakewood.
Yeah.
You know, that's not as much the issue as I'm over levered and got debt in, you know, this time period versus that. I locked for 5 years instead of 10 years, whatever, right? I got bridge instead of fixed for 10 years. That's more what's driving those motivation factors. And so the stuff we're running into that's opportunistic is very not area specific, right? Versus much more just that's how they structure that capital stack. And so if you can be present at those deals when they come to market, right? Work through them. And a lot of times the deals that are trading, we'll get calls saying, hey, I would have bought that, right? The deal trades for $1. Like, I would have bought that. Well, the deal didn't go out at $1. The deal went out at $1.30, and then it had to be discussed. And then it was out there for 3 or 4 months.
Got to stay around.
They got offers at $1.10 and then $1.05. Well, now we're taking it. Well, now they're at $1 because your NOI got worse and stuff like that. So you got to be around the hoop and you got to massage it. It's not just the deal hits the market at $1 and it sells for 99 cents. You know, that's just not the flow of a deal today. And so you got to kind of be around the hoop and work through it and be aware of it and be present when it's ready to strike.
The market has to speak on these deals, and that takes time.
It takes time.
So some of these deals that launched a couple of years ago that wanted yesterday's pricing, you as a broker have to deal with that more than ever. It's about, hey, this is where the market spoke. Then maybe a year from now, they're like, let's test it out again. And it's a, you know, maybe operationally a little bit tougher, capital markets a little bit more stable, market speaks again and again until the seller might be ready to meet the market. So,
and it's you know, people say it's not easy to take that hit. You know, if you got $1 and you're going to get 50 cents, that hurts.
Yeah.
It's not an easy decision to take. And so you want to fight for it. You want to believe that there's a reason to get 80 cents back or 90 cents back or whatever, instead of just being like, well, my broker said 50 cents, so let's just do it. It's like there's a lot of reasons that go into that, and there's a lot of problems it creates for that person, whether it's for his investors or the money that that person has or net worth. I mean, there's problems.
Yeah.
So it's not just an economic, hey, this is the value today, so let's just do it. It's not an easy decision to make. So you got to work through it a little bit and have someone truly believe that. What changed today is people don't push back as much when we say, let's say something's worth $1 and they want it at $1.30. There's not as much of that pushback in terms of, I don't disagree with you that the value is $1. Maybe I'm, $1.02, 98 cents, whatever. But the discussion isn't about the value. The discussion is strategically within my ecosystem as an owner, does it make sense to take that $1 today or not? Mm-hmm. Should I refinance? Should I just wait for it to perform? Should I raise money and put capital into it? Should all the things that they could do, but it's not as much of a discussion. In 24, early 25, it was a little bit of more of a, this should be worth $1.30. And what changed was in 24 and 25, if your NOI in 23 was, let's say $1, in 24 and 25, maybe it became 98 cents, 97 cents. But, it got a little worse, but wasn't that worse relative to the buyers had dropped significantly on their valuations because the interest rates went up so much, right?
Exactly.
So interest rates are up 50%, but NOIs are down 2%. So from a buyer's standpoint, their mortgage just skyrocketed. But from an owner, he's like, well, my mortgage is still the same and my NOI is down 2 cents. Right. So I'm not moving on my price. Then Q2, Q3 hit really for the country, let alone specifically Denver. And NOIs went from $1 to 80 cents, 70 cents, depending on where you're at. Well, all of a sudden, one, they say, well, we'll apply the same cap rate to 80 cents. Now we have much less of a gap in terms of buyer-seller, right? And then two, as the seller, it becomes a lot more painful to wait, right? When you're at 80 cents, instead of cash flowing your capital calls, you're not cash flowing, you don't got money for CapEx, your cash out refis, now cash in refi. So you have a lot more problems in waiting. And that's what we're seeing come to fruition now is waiting's painful. Instead of having 5 options, I have 2 options, sell or cash in, whatever. Typically, option B is write a check one way or another.
Yeah.
And some people can do that, right? You're betting on your asset, right? In certain assets, you totally should do that. And that makes sense. Like, hey, this is a great asset. Throw some money, wait. That makes all the sense in the world. You should do that. But other assets are like, someone else should come in here with whole flesh capital, fresh debt, fresh whatever. And you should probably move on, right? Certain deals are more of a lemon than not.
And a lot of those buyers weren't expecting to be in it for 3 to longer than 5 years, right? And
their plan was not that.
So now they're in uncharted territories almost.
Right, and their LPs want the money back, or they got to fix maybe another problem that's even worse.
Right.
You got a lot of there's just a lot more problems. And so you're trying to juggle that instead of everything's doing just fine, man. I know you got the interest rate problem, Mr. Buyer, but that's not my problem.
Right.
Well, now it's kind of your problem, because your debt's coming due and all that fun stuff.
I want to, you mentioned about Cap Hill, like briefly.
Yeah.
Cap Hill's interesting to me because when we entered the market pre-COVID, it was such an amazing, vibrant, and it still is. Like, I don't want to rip it too hard, but A, the supply I feel like has taken some of that renter pool, and B, I feel like it might not just be as, I don't know, like you tell me, but like it just might be as like have the same energy as it once had. Maybe
it's lost it for sure.
Yeah, right.
It was.
Do you think that's going to come back?
It was the absolute darling my entire career.
Exactly.
And then the people that trained me, right, and they were in the market 10, 20 years prior to that, it was a darling for them, right? So it's been the darling 30, 40 years.
And they're beautiful properties still, like so charming, so nice. But like, I think the supply, the new product, the brand,
the tenant base totally would rather live in a new build with a pool,
exactly,
and all the beautiful new stuff than the asset that's 100 years old.
Yeah.
Right. And so that's pulled them for sure. And yeah, I don't know. There's just a lot of operational difficulties of it. They're harder to manage because most of them are sub 50 units.
Right.
And so I think that's been the other big miss. You got the pull from the supply, right? So you naturally are less attractive, right? You're trying to compete on rents. And then two, the quality of the management is far inferior to the big boys.
Mm-hmm.
And so just how to run them and how to deal with them, how to attract tenants and spend the money to bring that tenant in and hit the rent number that you got to hit to get them in the door, economically makes them really tough. I mean, those values are absolutely down today. They're starting to trade again. There's very, very little trades in Cap Hill in 25.
Yeah.
Like record setting low.
I mean, that's like really peak to trough. Like that might be the biggest.
It's probably the biggest drop
in Denver.
Yeah.
Don't you think?
Yeah,
like
don't totally probably like it's absolutely up there. One of the biggest drops because that used to turn over and trade and whatever. And it's been super light. I think there was 4 or 5 trades this month, and even last week, I think there was 3 or 4. We're going through it in our meeting, and so it'll start trading again. I mean, it'll start trading. It'll just be a reset basis instead of 200 a door. It's 120 a door. I mean, it's a big swing.
Do you think do you think there's an opportunity there? I guess it goes back to what
it goes back if you can operate it.
Yeah.
Like there's a lot of deals that you would just point out, saying, "Oh, maybe I can get off 5-10% of that value," but that value I believe in, right? I like that price per unit. I like the asset, I like the whatever, but how do I run it? How do I finance it?
Yeah.
And the other thing on these deals, if you're under $5 million, you're trying to buy some smaller deal in Cap Hill, the debt is not very good.
Yeah.
You're at 6%. Well, I'd kind of like to get positive leverage on this deal. Well, now I'm at a 6.25 cap on this depressed NOI. And so that really hurts. So like for this stuff that's under 10 million, and really, especially under 5, it's none of the boxes are being checked today.
Yeah. That's
so
more
those
expensive
are just totally dead. So like the deals we're working that are 10, 20, 30, 40 million.
Yeah.
The boxes are checked so much better than on the smaller stuff that used to really trade throughout the city.
Right. Right. I guess let's talk a little bit about capital. Okay. So you're here in LA making your rounds, talking to owners. Max right now, I was telling you, is in New York. He's raising capital in New York right now. And it seems like you got to go outside of your market to find who's going to buy the next deal or who's the next listing, and how is these deals getting capitalized. I guess based on your conversations with the meetings in LA you're having right now, or whatever you're going to meet owners, how are they expressing to you like that we're going to get this deal done, and how are they capitalizing deals right now?
Gosh, how are people raising money? It's probably a tale of 2 totally different worlds. If it's people that are buying, let's say, 20 million and up, they typically seem to be good to go. Whether they already have the fund or they got their investors lined up, because there's no lack of capital out there. It's just lack of capital necessarily ready to write the check for your deal.
That's very true.
But it's not like they don't have the money. They're just not ready to give it to you. Yeah.
It's a lot of liquidity, but it's like, is it for that deal?
Yeah, is it for that deal? Right. They're like, no, we have money. We're just not going to give it to you right now. You're like, okay, cool.
Yeah.
Which is very different than 09, 10, 11, right?
Yeah.
Everyone just don't have the money.
Right.
And so it's a very different story. But if you have those assets, if you check the boxes, if you're 1990s, 2000, decent area or newer, value add, you're getting agency debt, right? The biggest thing to the size range is you're getting agency debt. So the leverage is so much better, non-recourse, all that stuff. You're generally finding the money. right? They're generally finding the money in different pockets. When you get sub that, it's tough. But really, the people that are making it and being more aggressive, they're playing with new money, right? And one of client that always seems to be ahead of the curve said it really well. He's like, I can't go back to the LPs that I've been using the last 5 years, because if they invested with me and they invested with 20 other people, their dollar's now 60 cents, 50 cents, 40 cents. And so one, they don't have that money back yet. Two, they're going to get back less than they had. And so they're probably not my investor. One, they're a little burned. And then two, they may not be interested at all anymore. They don't have the money to invest in the first place.
And that's the case with a lot of that retail capital, for sure.
Absolutely. Absolutely. And so he's like, comparatively, and he gets a lot of exposure to Phoenix and LA and different spots. He's like, yes, multifamily and commercial, let's focus on multifamily, has gotten crushed the last 3-4 years. But there's this other world that if you're in real estate, maybe you're not as exposed to, if that makes sense, that is printed money for the last 2-3 years. If you bought NVIDIA stock 3 years ago, you have a lot of money. If you bought Bitcoin, if you bought gold, if you bought all the big seven, you made a lot of money in the last 3-4 years. And he's like, so those are the people I'm going after. He says, hey, I bought Bitcoin for 5,000 a coin. Now it's at 80. I'm going to sell 10 of them and give you $1 million and now go invest at a better basis in real estate. Yeah. And so there's a lot of money out there. It's just who's finding the people that made a bunch of money prior. He says, hey, you know what, at 80 grand, maybe I'll sell my coin or I'll sell my gold or I'll sell NVIDIA at a $4.5 trillion market cap, take some chips off the table and then diversify it into other things. And we're starting to see that in terms of money loosening up, right? But if you were making XYZ on NVIDIA in 24, 25, you didn't want to hear about the pitch about, hey, go give me money and make 8% as a, as an LP. You're like, no, I'm doing nothing and just printing money here in this other bucket. Right. Stocks are murdering it right now and I'm not taking any of the risk. And so a lot of that capital got tied up, and we are seeing how today that capital is loosening up because now they're trading at such high metrics. Money's coming out of that a little bit and starting to diversify. And then obviously values and the story has helped, right? Where our world's getting a lot more stable, where the floor is a little bit more established, rates are more established, the new world order is more established in our space, right? Yep. So you're not investing in a falling knife, maybe as you maybe perceive it in 25 versus 26. You're like, maybe I'm bottom, maybe I'm not, but I'm close enough that I'm willing to step in. Yeah. And take a shot.
I have a lot of friends outside of the real estate industry that are investing in stocks, and they're just trading on their phones. They say if my investment's not on my phone, I don't want it.
Right? They're like, give me 25 grand. They're like, no, I'm doing this.
Yeah. But it's actually the tone is shifting with a lot of them, because the mainstream thought right now for some of those investors is that you're seeing, AI is like the top 1, 2, and 3 subject, right? And they're seeing how AI is starting to take jobs, and tech companies are starting to cut human capital, and their earnings are shooting up. And when their earnings are shooting up and their stocks are rallying and they're getting, gains on paper, what happens is that you're now starting to hollow out some of that, the renter base, the middle class, some of that. And the take right now, like if you talk to them and on Twitter, and you're seeing it on Twitter, is we're going to actually see some sort of like an economic weakening in the labor market. And what's the Fed going to do? They're going to have to actually like cut rates, or bonds are going to rally again. And who's going to sit pretty when that happens? Real estate, because there's no supply right now. And then you're going to get cheap debt. And as you said before, maybe your NOI instead of like $1 is maybe 98, 97 cents. Yeah. Denver a little bit lower, 80 cents. But when that supply burns off and maybe you start to see bonds rally and you have cheap debt, real estate's going to look really good right now. And so this is like a time where if you're out of the CRE market and you're investing and you're looking at your phone and you're saying like, wow, why would I invest in CRE? The smart ones are saying, no, you know what? It's smart to diversify, because this could be a good play now where the market's heading, where CRE is gonna be on top.
We're certainly seeing new money get in the market. I mean, that's the reality. And it's really...
And it's not your typical institutional partner that you're going to JV with. It's like guys who have their own investments outside of real estate, or they have their own business that's been printing money, the attorneys, the doctors. Yeah, people are changing. I mean, like we had 10 offers on the Salt Lake deal, 9 were out of state, and I think 7 did not own in Utah yet. Yeah, for example. Like they were new to, now maybe they weren't new to the game totally,
right? But they were new to the market. And we're seeing that across the board. It's just a total shift. And there's always, there's these changes where people's like, oh, you've been in the business a long time, you know everybody. And that's totally true. However, to be in this business, your relationships take a pretty heavy reset about every 5 to 7 years. The GFC, total reset. Who was your client in 07 was not your client in 2010.
Right.
Your client in 2010 was not your client in 2016. Your client in 2016 really changed at COVID. There's kind of the pre-COVID buyer and the post-COVID buyers who just embraced, saw the code writing and were all in, and others were more conservative. That changed everything. Now with rates up, who the buyers are today is totally different than who the buyers were pre-rate hikes. So you really reset those relationships and who's at the table. And not all of them, it's like at least half kind of get reset every like 5, 6, 7 years, it seems, and who you got to deal with. And not as a broker, no matter how long you've been in it, you got to pick up the phone.
Yeah.
You're back to
the process.
My
is the
name's
same.
Jason. Would you want to sell your building? Like you're back to the basics, like every 5, 6, 7 years. Like ideally you're better at it, or maybe they heard your name before, but the basics never go away. One guy that trained me at Unique, he's like, as soon as you stop making cold calls, it's the day you retire. No one knows it.
Yeah.
But you always got to make the new relationships all the time. It doesn't work.
Yeah. So I guess to wrap it up, piece of advice. I actually want to know from you specifically a piece of advice for someone that wants to break into Denver, right? Because you're seeing how it is. Maybe like we talked about Salt Lake City, how you guys had a deal and you have all these out-of-state buyers. And I feel like you're going to have the capital that's new to the game saying, I know Denver's great long-term, but it's bottoming right now and I want to break in. Like, what's your piece of advice to them that's trying to break in?
You will have a competitive advantage if you figure out the management piece. If you are confident in your management, you're confident in how you can raise the rents, keep expenses good, keep the operations tight, you will have a competitive advantage who you're competing against to win those deals. And the bigger you get, the tighter that gets, right? The other big boys, they got management pretty dialed in too. And so you got to find a little bit more of those opportunistic scenarios, but you got to have that management answer with you. So that's the biggest crux of it. But if you can have that, then you will outperform the other people you're competing against. And management's the hardest part right now.
Totally. I think that's our edge right now.
Yeah.
Self-managing.
It's an operations game these days.
Totally an operations game and makes us harder maybe to lean into a deal with everything you're seeing, but definitely makes you feel a bit better once you're in it, of saying like, okay, we can outperform what we've expected. So harder for us to maybe raise equity on that, but it's like once we're in it, it's like, oh, we know we will do better than what we underwrote because we're already doing it.
Absolutely. Yeah. If you can figure out the management play, you can be very competitive and do really well. Because there's a lot of inefficiencies in our market right now.
Yeah. Well, Jason, great having you on.
This is awesome. I'm so happy we got to do this. This is fantastic.
You only have a couple of days here, and I'm glad you carved it out to,
Dude, absolutely,
to hop on the pod.
I'm always happy to see you.
And we'll keep it going.
Absolutely.
Let's get something on the board this year. Awesome.
We will.
Awesome.
All right, that was fun.
That was great. Yeah. Good shit.